Hi everyone, I'm Karunya Rao and in Ideas for Profit, the spotlight is on HDFC Bank. It posted a healthy performance in Q1 FY22 with net profit rising 16% year on year. However, it was marginally lower than the bank's historic trend of 18 to 20% earnings growth. During the reporting quarter, disruption caused by second wave of COVID-19 impacted profitability as the bank showed up provisions to deal with future contingency. HDFC Bank's collection efforts were hindered and this led to a slight weakening of asset quality. Though the earnings growth in the June quarter was the lowest seen in many years, the core operating performance remained strong. Despite moderation in retail lending and restrictions placed by the RBI on its credit card business, the bank's loan growth was much higher than the industry credit growth, implying HDFC Bank is gaining market share at an accelerated pace. Margins continue to be the best, though moderated by 10 basis points in Q1. Asset quality has also held up relatively better than peers despite the testing times. Q1 performance highlights that HDFC Bank cannot escape the impact of the economic crisis induced by the pandemic. However, it is definitely well equipped to see through the challenging period and can emerge much stronger from the crisis by consolidating its market position. We see Q1 FY22 as a speed breaker, not a derailment in the bank's long journey going forward. While the private lenders' earnings were impacted in Q1, the pandemic and the regulatory embargo do not permanently impair its long-term earnings potential. Strong revenues led by a healthy loan growth, low cost of funds and a buffer of high provisions will limit the downside in earnings even if credit cost remains escalated for a couple of quarters. Besides, the stock's relative underperformance more than adequately captures the challenges faced by the bank, making it a worthy buy. HDFC Bank reported total advances of 11.47 lakh crore as of June and a healthy increase of 14% over last year. Wholesale loan growth was subdued at 10% year-on-year as corporates continued to deleverage. Retail loan growth decelerated to 9% YOY due to almost flat vehicle financing book, cautious stance on personal loan portfolio and RBI's restrictions slowing down credit card business growth. Growth in deposits was strong at 13% YOY. Within deposits, the low-cost CASA deposits saw a robust 28% year-on-year growth. Consequently, CASA ratio increased to 46% of deposits, which is an improvement of 540 basis points year-on-year. HDFC Bank's cost-to-income ratio stood at the lowest level of 35% in Q1 FY22 and was a key driver of profitability. The CI ratio is expected to inch up in the medium term with restoration in business normalcy and increased investments in building the franchise. The thrust on digitization and the focus on low-cost distribution network in rural and semi-urban areas have significantly improved operating efficiency in recent years and helped the bank maintain healthy earnings growth. Pre-provision profit growth was healthy at 18%, enabling the bank to provide more for future contingencies. Despite a healthy loan growth of 14%, NII growth was muted at 9% as NIMs moderated by 10 basis points to 4.1%. The NIMs decline was driven by interest reversal due to elevated slippages, low-yielding asset mix and higher liquidity. The high-yielding revolving balances on the credit cards business have declined, leading to lower yield on overall advances portfolio. The bank saw higher slippages of around 2.5% during Q1. Also, collection efforts were disrupted as almost 35-40 business days in the quarter were impacted by second wave of COVID. Consequently, both gross and net NPAs inched up. Despite the increase in provisions, the provision coverage ratio reduced to 68%, a decline of more than 800 basis points year-on-year because of the increase in NPAs. HDB Financial Services, which is a subsidiary of HDFC Bank, it posted a weak performance in Q1. Weak loan growth of a mere 1% and higher provisions led to Q1 FY22 profit degrowth of 44%. Asset quality deteriorated as GNPA ratio increased sharply from 3.9% in Q4 to 7.8% as of June end. HDB's performance indicates stress at the bottom of the pyramid. HDFC Securities reported a strong set meanwhile with profit rising 95% in Q1 on buoyant capital market activity. HDFC Bank's valuation has fallen to a multi-year low while long-term growth and profitability outlook are still very strong. This implies that the street is extrapolating the temporary blip caused by the pandemic as a long-term concern, which we think is unreasonable and presents an opportunity in fact. The regulatory embargo has added to the stock's underperformance. At the current market price, HDFC Bank is trading at 2.9 times its core book value estimated for FY23, assuming a conservative earnings growth of 14% CAGR over the next 2 years. This is at a significant discount below its historical long-term average valuation multiple of 3.5x. There's no doubt that HDFC Bank's earnings growth has declined from 30% a few years ago to 20% levels in the last few years and can possibly moderate further in the near term if the adverse economic situation persists and virus risk doesn't abate. But as Warren Buffett says, we don't buy something with earnings that go up the next month or the next quarter. We need something that will earn money 5 to 10 years from now. So given the ROA of 1.9% and ROE of around 16 to 19%, valuations can revert to historical mean levels. This, along with earnings growth, can lead to meaningful upside in the stock price over 2 to 3 years. The lifting of restriction by the RBI, of course, will be a key trigger in the stock price to watch out for in the medium term. It is rare to find a high-quality business with predictable earnings growth at compelling valuations. Therefore, investors should use the current weakness in the stock price as an opportunity to buy.